The front end of the yield curve is starting 2025 at a level where investors no longer need to anticipate big moves in interest rates in order to see strong total return potential in fixed income. At these levels, for many investment objectives, simply earning income is enough. We've reached this point while the outlook on both economic growth and inflation remains uncertain, thanks in part to shifts in U.S. domestic policy, trade policy, and immigration policy, to name a few. These unknowns could cause the performance of short-term bonds and long-term bonds to diverge. For example, in a scenario with sticky inflation and persistent fiscal deficits, short-term rates could remain elevated while long-term rates could move higher. Prices on short-term bonds are less sensitive to changes in interest rates, and they are typically less volatile. For short-term bonds, the higher for longer trend is your friend. The consensus outlook for the U.S. economy in 2025 is a Goldilocks scenario in which the economy grows, the unemployment rate stays steady, inflation continues to decline, the Fed is relatively inactive, and the Trump administration successfully executes on major campaign initiatives. While this is certainly possible, we think outcomes may deviate from expectations as the year progresses. After another year of above-trend growth, we believe that the near-term growth rate has more downside risk than upside. We also see the risk of a further rise in the unemployment rate. The pace of hiring has slowed sharply, which is now below pre-COVID levels. Therefore, any uptick in layoffs will have an outsized impact on the unemployment rate. The Trump administration's policy and the sequencing of its implementation may also impact the trajectory of growth and inflation. Lower immigration and tariffs can be implemented quickly, which could weigh on economic activity and put upward pressure on inflation as well. And while changes to tax policy and a lighter regulatory touch would be positives for growth, these policy changes could take longer to enact. Nonetheless, after a volatile year for Treasury yields, 2025 opens with fixed income markets offering solid compensation to buffer against uncertainties and positioned to reclaim their long-term role of income generator and portfolio diversifier.